Welcome to another explainer. Okay, let's just dive right into this because honestly, there is something incredibly strange going on with the American economy right now. I mean, on one hand, you've got a situation where the stock market is absolutely soaring. Gold is up, GDP is up, and pretty much everything points to a booming economy. But on the other hand, people are facing this harsh, almost terrifying reality when it comes to actually finding work. It's a bizarre, completely contradictory paradox. So today we're going to unpack exactly what is happening under the hood of this economy, and we'll use the data to show you why it feels so unbelievably good for some and so devastating for others.
To really grasp this, we need to look at the sheer contrast of the current landscape. Since the recent election, the stock market has gained almost $3 trillion in value. Americans literally have more money in stocks than ever before. So naturally, you'd assume the job market must be booming right alongside it, right? Well, it turns out the hiring rate, which is just the share of the total workforce getting hired every month, has completely collapsed. The last time we saw it sustained at this low of a level was during the absolute lowest point of the 2008 global financial crisis. It's wild. We are essentially in an absolute jobs crisis, hiding right beneath the booming stock market.
Section 1. The brutal job hunt.
So let's step out of the macroeconomic data for a second and look at the actual reality on the ground. Because if you already have a job, you might not even realize anything is wrong. But if you find yourself needing to look for one right now, it is an absolute dust bowl out there. To see this in action, just go online. Say you're a new grad, or you just moved, or maybe you got laid off. You open LinkedIn and search for a job. A writer at Condé Nast, over 100 people applied. A job at Duolingo paying a fairly modest tech salary, over 100 people applied. A games associate writer at the New York Times, over 100 applicants. And here's the kicker, LinkedIn actually stops counting at 100 just to avoid discouraging you. If you apply for a standard white-collar job today, you are instantly up against a massive wall of competition, making your statistical odds of landing the gig worse than getting into Harvard.
And it doesn't get much easier even if you lower your expectations. Let's say you're getting desperate. You're not too proud. You just need to settle for something to pay the bills. So you search for a barista position. But here is the catch. You need healthcare. If nothing else, you just want basic medical insurance benefits. Well, when you apply that one simple filter, the results plummet from 440 jobs down to just 18. And those 18, they are absolutely swarmed with dozens of applicants too. Every single listing gets a zillion qualified applicants. Millions of people are stuck in this exact trap right now.
Section 2. Who took the jobs? Which brings us to the most pressing question. If the economy is overall supposedly growing, where on earth did the jobs go? What invisible forces are secretly suppressing hiring? Well, the absolutely crucial point here is that it isn't just one thing. It's actually four converging economic culprits that are collectively choking off the labor market. We're talking about AI quietly taking over entry-level work, heavy import tariffs strangling business capital, massive government layoffs flooding the market with job seekers, and high interest rates making borrowing, and therefore hiring, way too expensive. Let's quickly break these down to see how they all interact.
First up, let's look at government layoffs. Between Elon Musk's Doge agency closures drastically reducing departmental headcounts last spring and government shutdowns in the fall, the federal government, which, by the way, is the country's biggest employer, dropped 271,000 jobs in just a few months. That single drop equals 1/10 of the total job losses from the entire 2008 financial meltdown. And these aren't just folks sitting in Washington, D.C. They're spread out in every state, across every white-collar field, accounting, sales, marketing. So suddenly, if you're applying for an office job, you're competing against hundreds of thousands of newly displaced, highly qualified former federal workers. Now let's talk about tariffs and interest rates, because this brilliantly illustrates the impossible dilemma facing Federal Reserve Chair Jerome Powell. Think of it as a three-step cycle. Step 1. Tariffs act as essentially a 10 to 20% tax on imported goods, and since half of U.S. imports are literally just parts and raw materials used by American businesses, things like lumber, machinery, even tomatoes, tariffs make everything more expensive, which causes inflation. Step 2. To fight that inflation, the Fed is practically forced to keep interest rates high to slow down spending. Step 3. Those high interest rates mean it's incredibly expensive for businesses to borrow money. If a business can't borrow cheaply, they definitely can't afford to expand or hire. Powell has essentially admitted that tariffs lock in inflation, which locks in high interest rates, creating this perfect storm that blocks out new jobs. And what about artificial intelligence? Federal Reserve data shows companies aren't really firing their current staff to replace them with AI. So, it looks completely fine on paper. But surprisingly, as writer Derek Thompson pointed out, AI isn't replacing your current job, it's replacing your next job. Because borrowing money is so expensive right now, companies are absolutely desperate to save cash. So instead of a law firm hiring a new entry-level paralegal or a consulting firm taking on 20 new grads, they hire maybe 5 grads and just give them AI chatbots to do the bulk of the entry-level work. They aren't firing people en masse, but they are erasing the very opportunities new graduates completely rely on to actually enter the workforce.
And the sheer scale of this capital shift is massive. Right now, investment in AI data centers is sitting at around $3 trillion. Let me put that into perspective. That is basically the entire US economy. Why is this happening? Well, because tariffs make it incredibly hard to turn a profit in any traditional industry that relies on importing or exporting. So the entire economy is taking every extra dollar that would have gone to starting a new factory, a call center, or a magazine, and they're just dumping it into humanless AI data centers, mostly because that sector is remarkably resilient to tariffs.
Section 3. The deportation effect.
This severe job scarcity brings us to a major political proposed solution: mass deportations. Some politicians have argued that removing immigrants will naturally free up jobs for American citizens. Today, we're going to look strictly at the economic data and historical models to see if that strategy actually works. To understand this, we have to define an economic principle called complementarity. This is the idea that jobs predominantly done by immigrants directly complement, support, and sustain the jobs that are predominantly done by native-born citizens. It's a foundational concept for understanding how different parts of a labor market deeply rely on each other to even exist.
Here's how this works in practice. On one hand, we have immigrant labor, which often fills strenuous, dangerous, long-hour roles like manual labor and heavy construction. On the other hand, we have native-born citizen labor, which tends to fill complementary roles. Think foremen, site managers, architects, and accountants. Now, the intuitive logic of deportations is that if you remove the manual workers, the citizens will just step in and take those manual jobs. But economically, that simply isn't what happens.
We know this for a fact because economists rigorously analyzed the nearly 500,000 deportations rolled out during the 2011 Obama era. They looked at the data county by county, and what they found was that native-born citizens did not step in to take those strenuous manual jobs. Instead, the construction firms faced massive labor shortages and had to shrink their operations or close down entirely. And because those businesses shrank, the complementary white-collar jobs vanished with them. The data showed that for every 100 undocumented immigrants removed from the labor market, 12 native-born citizens mathematically lost their jobs too.
When economists apply this historical data to current mass deportation proposals, the numbers are frankly staggering. They project that collapsing industries heavily reliant on immigrant labor, like childcare, agriculture, and construction, could put up to 2.5 million native-born jobs at risk. That includes 800,000 potential job losses just in the construction sector alone. So, looking at it from a purely economic standpoint, this approach historically acts as a massive driver of joblessness rather than a fix.
Section 4. The K-shaped economy.
Okay, so let's zoom back out. We've looked at all these forces crushing the job market. But remember our original paradox. How can the economy be devastating for job seekers, yet simultaneously be producing massive, record-breaking numbers? Well, to understand this, we need to look a little closer at that booming S&P 500. It turns out it's largely an illusion. If you split the data, the top is being completely driven by just 7 massive tech stocks, going absolutely gangbusters, fueled by that $3 trillion AI investment we just talked about. But look at the rest of the stock market, it's essentially flat. The economic activity is incredibly concentrated in just one tiny sliver of the market.
And this brings us to a brilliant concept, coined by economist Peter Atwater. It's called the K-shaped economy. It describes an economic reality where one segment of the population absolutely thrives and builds massive wealth. That's the top arm of the K reaching upward, while another segment simultaneously plummets, the bottom arm of the K pointing downward. It's not just standard income inequality anymore. It's a structural change, causing two groups that used to be pretty much in sync to violently diverge.
The timeline of this explains perfectly why consumer confidence is so deeply, wildly split right now. When heavy inflation hit the market, it acted as a massive divider. If you were an asset holder, meaning you already owned a house or maybe had a healthy 401k or stock portfolio, inflation actually made your assets much more valuable. You basically rode the top of the K upwards. But what if you were a wage earner, relying purely on a paycheck or actively looking for a job? Well, you got hit with extreme job scarcity, high prices, and fierce competition. You rode the bottom of the K downwards. It's quite literally two completely different realities existing at the exact same time.
And you know what makes this particular K-shaped economy so utterly unique? It's the very nature of the boom at the top. Historically, when an industry boomed, it brought the middle class right along with it. The auto industry built Detroit. Earlier tech booms built cities like San Jose and Seattle. But the AI boom is entirely different. It creates unprecedented wealth for investors, but it doesn't create boomtowns. $3 trillion flows into giant, humanless rows of high-priced processors. It generates massive capital for the top of the K, sure, but it creates virtually zero regional jobs to sustain the folks at the bottom.
Which brings us to the ultimate takeaway of this explainer. The reason the economy doesn't feel like a 2008 freefall to absolutely everyone is because the top half of the K is doing just fine, keeping things generally afloat on paper. But as the labor market remains stalled, more and more people are slowly sliding down to the bottom half, because sooner or later, your company might close, or you might want to switch careers, or you might graduate. So I'll leave you with this thought. When you inevitably need your next job, where will you be on the K? It's a haunting question we all have to face in this wildly fractured economy. Thanks for joining me on this deep dive into the data.